Hello traders, Gary Wagner here, 11:25 in Honolulu and 5:25 in New York on Tuesday, 29th day of March, 2022, and this is the daily report for gold and silver. Gold prices continue to drift lower now for the third consecutive day. When we look at today's low on this daily chart here, or on this daily chart here, we can see that the last time gold traded to this area was right around the last week of February. It also matches up roughly with this top that occurred in November of last year. Currently, we have April futures at $1,918.40. However, we will quickly move into the next contract month, and that is the June contract month, which is currently down $20.50 at $1924.20. Today's $20 drop in the price of gold was highly tempered with dollar weakness. The dollar index lost 0.6% and is currently fixed at 98.48. If not for dollar weakness, you could have added another $17 in terms of today's decline. While silver declined over 1%, 1.14%, or 29 cents, with the most active contract fixed at $24.91, what I am drawing my attention to is this exaggerated low that came in here roughly at $24, the low 24.04. While it did recover, it did close lower on the day, and it closed lower when compared to yesterday's close. Today's low, as well as its close, was absolutely significant. While 2 days ago, we did see a low break below the 50% retracement at $1,915. That retracement was created from this last leg of the rally, 1752, up to 2078. Breaking below on a closing basis, the 50-day support level definitely lines up for a major support level at the 61.8% retracement. That comes in at $1,877. Should that not hold, although I believe that that is not a high probability, the next level we would look at would be $1,824.20, and that is based upon the 78% Fibonacci retracement level. Let's see if in fact the market tracks as low on a closing basis at 1877, and then look to see whether or not it does find any kind of support. This is still based on the April contract, and of course the June will become the most active contract month in the next few days. Luckily, we are flat with no active trades after pulling a small profit, entering a June position at 1933, and then trailing our stop up to 1944, which of course was hit with about $1,000 profit per contract. We made money on our spot trade, and we made a little bit of money on GLD. The key is we did not sustain a loss as this market came down. The vast majority of analysts writing commentary on gold pricing today focused on two primary issues. First, what the Federal Reserve plans to do when the FOMC meeting convenes in May, and secondly, some light at the end of the tunnel, so to speak, in regards to the discussions or negotiations between Ukraine and Russia. I purposely omitted any discussion about the ongoing talks between Russia and Ukraine because, quite frankly, I don't believe that anything Russia says has any truth whatsoever. They will stall by having negotiations until they reach their goal, which is, I believe, to take over Ukraine, or at least level it, replace the government, and disarm the military. So to me, it's all about the Federal Reserve. I think that as far as the conflict in Ukraine, that will get much worse before it gets better, and it will not end in a way that will satisfy any of the free world. But here is what I find very, very alarming that was released today by the Federal Reserve Bank of Cleveland. They come up with their CPI numbers well ahead of when they're released. And they are forecasting not only February, that will be released on the 31st, but they're also forecasting the CPI for March. And for the first time, we're seeing the numbers that will come in for the first quarter of 2022. And I draw your attention because they are alarming numbers. First of all, their forecast is that we will see inflationary pressures for the first quarter of this year just over 9%. And the numbers for March, they believe will come in at 8.41%. And if in fact those numbers are correct, which I believe they will be, that will force the hand of the Federal Reserve to be even more aggressive than currently anticipated, which means that I expect a rate hike of 0.5% to be the announcement in May rather than a 0.25% rate hike. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.